Most people spend years planning their retirement. They calculate their savings. They estimate their Social Security. They picture the day they finally walk out of that office for the last time. And then they pick a date. And almost nobody realizes that the date they pick, the specific month they choose to retire, quietly follows them for years. It shows up in their tax bill. It shows up on their Medicare statement. It shows up in the size of their required withdrawals a decade later. And by the time they see it, it's already done. The decision is already made. The cost is already locked in. And the worst part is that most of the people this happens to had plenty of time to choose differently. They just didn't know what they were actually choosing. Today, I want to walk you through something that almost nobody talks about clearly: the hidden financial consequences of your retirement date. Not the year you retire, the month. Because the difference between retiring in January and retiring in October of the exact same year can translate into tens of thousands of dollars in higher taxes, unexpected Medicare surcharges, and a larger required minimum distribution burden that compounds for decades. This is not a theoretical risk. This is something that happens quietly to real people every single year, and it is almost entirely preventable with the right information and the right timing. We're going to go through exactly how this works, why it catches people off guard, and what you can do about it, whether you're planning your retirement date right now or you've already retired and you're trying to understand why your financial picture looks different than you expected. And if you're someone who's been watching this channel for a while, or if this is your first time here, please hit like and subscribe. Here on Mr. Retirement, breaking down these hidden retirement mechanics in plain language is exactly what we do. And there's a lot more where this is coming from. Let me start with a concept that I think makes this whole thing click immediately. Imagine the IRS takes a photograph of your financial life on December 31st of every year. Just one photograph, one snapshot. And that photograph, that single image of your income for the year, is what determines your taxes, your Medicare premiums, and several other financial realities for the months and years that follow. It doesn't matter how long you worked that year. It doesn't matter whether you retired in February or November. It doesn't ask whether you were employed for 6 months or 12. It just captures the total. And that total is what you get measured by. Now here's the problem. Most people, when they think about retirement income, think in terms of monthly income. They think, I'll be getting this much from Social Security, this much from my 401k, this much from a pension. Monthly. That feels manageable. But the IRS doesn't think in months. It thinks in annual totals. And in your retirement year, the specific calendar year you stop working, you are almost always stacking two income realities on top of each other. The income you earned while you were still employed, and the income you started receiving once you retired. And that stack, that combination, is often far higher than your income in any other year of retirement, and far higher than you anticipated. And it can push you into places financially that you weren't expecting to go. Let me make this concrete with someone named Dennis. Dennis worked as a project manager for a logistics company. He'd been there for 26 years. He planned his retirement carefully, or so he thought. He had a solid 401k, a small pension, and he was planning to start Social Security at 67. His plan was to retire in October. He figured that gave him one last summer of work, a final few months to wrap things up, and then freedom starting in the fall. He'd been looking forward to it for years. His wife, Renee, was already retired, so October felt right. He would retire just in time for the holidays. What Dennis didn't account for was what October retirement actually looked like on paper by December 31st. He had worked 10 months of the year, earning his full salary through mid-October. That salary alone was roughly $82,000. Then he started his pension in November, about $1,800 a month. He also began a modest 401k withdrawal in December to cover some home renovation expenses, about $20,000. By the end of the year, his total income came in just over $107,000. He and Renee filed jointly. They'd never been in a high tax bracket during their working years, but in the retirement year he'd been dreaming about, they suddenly found themselves staring at a federal tax bill that was nearly $14,000 higher than anything they'd paid in recent memory. And it didn't stop there. Because here's the part that Dennis, and most people in his position, never saw coming. That $107,000 income figure, captured on December 31st, became the basis for his Medicare premium calculation 2 years later. That's called the IRMAA lookback. IRMAA stands for Income-Related Monthly Adjustment Amount, and it's a surcharge the federal government adds to your Medicare Part B and Part D premiums if your income exceeded certain thresholds 2 years prior. The thresholds for 2024 start at $85,000 for individuals and $170,000 for married couples filing jointly. Dennis and Renee were well above the married threshold in his retirement year, So 2 years later, instead of paying the standard Medicare Part B premium of around $174 per month each, they found their premiums had jumped significantly. For both of them combined, the surcharge added up to hundreds of additional dollars per month, costs they were not planning for, triggered entirely by the income stacking that happened in the year Dennis retired in October. This is the IRMAA trap, and it catches people constantly, not because they did anything wrong, not because they were reckless with money, but because the timing of their retirement created a one-time income spike that the Medicare system saw as their new normal and penalized them for 2 years after the fact, when the original decision felt like ancient history. Now think about this for a second. What if Dennis had retired in January instead of October? His salary income for the year would have been nearly zero, maybe a few weeks of pay at most. His pension would have started earlier in the year, contributing a smaller annual total, since it's a fixed monthly amount spread across more months at a lower combined figure. His 401k withdrawal could have been timed and sized in a way that kept his income well within a comfortable bracket. And his total annual income figure, the one that photographs by December 31st, could have looked dramatically different. Not because his life was different, not because his savings were larger, just because the timing was different, just because he understood how the snapshot works before he chose his date. But here's where it gets interesting. Because January retirement has its own set of considerations, and the right answer isn't simply always retire in January. The right answer is to understand the mechanics clearly enough to make an informed decision for your specific situation, and that's exactly what I want to give you today. Let me bring in someone else. Her name is Carol, and she retired from a school district in June at 64. She had a teacher's pension, a 403b account, and she'd been very careful about managing her finances throughout her career. She knew about tax brackets. She'd done her homework. What Carol didn't realize, and this is a mistake that surprises even financially aware people, is that her June retirement meant she received 6 months of her salary and 6 months of pension income in the same calendar year. Her salary for the year ran about $41,000. Her pension, once it started in July, paid her about $2,200 a month, adding another $15,000 to her annual income. She also made the decision to start a Roth conversion in that same year, moving $30,000 from her 403b into a Roth IRA because she'd heard that converting early was smart. And it is smart, but the timing created a problem. The $30,000 Roth conversion, the $41,000 in salary, the $15,000 in pension income, they all landed in the same tax year. Her combined income hit $86,000. She crossed into IRMAA territory individually, which meant her Medicare premiums 2 years later reflected that spike. She also pushed herself into a higher federal tax bracket than she had anticipated for the conversion, which meant she paid more in taxes on the Roth conversion than she would have if she'd done it in year 2 or 3 of retirement, when her income from salary was completely gone. She paid to convert $30,000 at a 24% effective rate when she could have converted the same money at a 12 or 15% rate if she'd simply waited one more calendar year. That single timing mismatch, converting in the same year she retired with a salary, cost her several $1,000s in unnecessary taxes. Not a catastrophic mistake, not a retirement-ending error, but a completely avoidable one. And once she understood why it happened, she was frustrated, because nobody had warned her. Nobody had explained that in your retirement year, every income source you add is adding to a pile that gets photographed on December 31st, and that pile determines more about your financial future than almost any other number in your retirement life. Here on Mr. Retirement, we talk about this stuff because it matters in ways that most people don't feel until they're already living the consequences, and the goal is always the same, to give you clarity before the decision, not after. Let's go deeper on the tax bracket stacking issue, because I want you to really understand the mechanics here, not just the examples, but the logic underneath them. When you retire mid-year with a salary, your income from work is already pushing you partway up the tax bracket ladder before your first retirement dollar even arrives. And each additional source of retirement income, whether that's a pension, a 401k withdrawal, Social Security, or a Roth conversion, stacks on top of that salary foundation. The result is that your retirement income gets taxed at the top of whatever bracket your salary already pushed you into, not at the bottom, not at a fresh 12% rate, at the 22% rate, or the 24% rate, or wherever the salary left you. This is sometimes called the tax stacking effect, and it's uniquely severe in the retirement year because it's the only year in your financial life when two completely different income profiles overlap. The year before, you were fully employed, high income, but predictable, manageable with standard deductions and a routine filing. The year after, you're fully retired, lower income, more control, more optimization opportunities. But in that single transition year, you're caught between both worlds, and you often pay the price of both. The reason this matters so much, The reason I keep coming back to it is that the retirement year is also often the year people make their most consequential financial moves. They start their pension. They make their first 401k withdrawal. They consider Social Security. They think about Roth conversions. They feel a sense of financial movement, of reconfiguration, and so they act. And acting in a year when your income is already artificially inflated by a partial salary means you're paying premium taxes on every single one of those moves. You're using your one-time lowest flexibility year to make your most expensive decisions. Now I want to introduce you to a couple named Frank and Helen. They did something that most people don't do. They actually planned their retirement date around the tax calendar. Frank was 63 and had been a senior engineer at an infrastructure company. Helen was 61 and worked part-time as a bookkeeper. They had about $900,000 split between a traditional IRA, a Roth IRA, and a taxable brokerage account. Frank's pension was about $2,600 a month once it started. They both understood Social Security would come later. Frank was planning to wait until 68, Helen until 67. Their original plan was for Frank to retire in September, just before their anniversary. It felt symbolic. It felt right. But their financial planner ran the numbers for them. And this is a moment I want you to really absorb, and showed them the December 31st snapshot comparison. If Frank retired in September, his combined income for that year would include 8 months of his engineering salary, a few months of pension, and the Roth conversion they were planning. His income would top $112,000, IRMAA exposure for both of them, a portion of their Social Security becoming taxable earlier than necessary. The Roth conversion taxed at 24%. Their estimated additional tax and Medicare cost over the next 3 years compared to a January retirement, over $47,000. Just from the timing, Frank and Helen moved their plan. Frank retired on January 2nd of the following year. His income that year was zero in salary. The pension started in January and ran all 12 months, but that was already factored into their budget. They did their Roth conversion in March of that same year, at a rate of 12% on the converted amount because their income was low enough. They stayed well below the IRMAA threshold. Their Medicare premiums 2 years later reflected that careful, intentional year. And over the 3 years that followed, they kept more than $40,000 that the original September retirement date would have quietly taken from them. Same people, same savings, same retirement goals, different date, different financial life. I want to pause here and address something, because I know what some of you are thinking. You're thinking, this sounds great, but I can't just pick my retirement date around the tax calendar. My company has a layoff. I have health reasons. I have a spouse situation. Life doesn't always cooperate with January 1st planning. And you're absolutely right. Life doesn't always cooperate. And I'm not suggesting that everyone can or should delay their retirement date by months just to hit a better tax window. What I am saying, very directly, is that if you have any flexibility in your timing, even a few months of flexibility, the financial difference can be enormous. And if you don't have flexibility, you need to know the consequences so you can plan around them, so you can make decisions about which income sources to activate and which to delay in that transition year, so you can avoid doing a Roth conversion in the same year your salary is still showing up, so you can keep your 401k withdrawal modest in your retirement year, and take more in year 2 when your income profile is cleaner. This is the kind of thinking that separates a reactive retirement from an intentional one. It's not about being rigid, it's about being aware. Let me spend a moment on required minimum distributions, because the retirement date also has a longer shadow here than most people expect. RMDs, required minimum distributions, are the IRS's way of saying, you've been deferring taxes long enough. Start taking money out of your pre-tax accounts. Beginning at age 73 for most people, and at 75 for those born after 1960, the IRS requires you to withdraw a minimum amount from your traditional IRA and 401k each year. The amount is based on your account balance at December 31st of the previous year, divided by a life expectancy factor. And here's why your retirement date connects to this. If your retirement year income was high, because of the salary overlap we've been talking about, and you didn't use that window for smart Roth conversions, your pre-tax account balance may still be large when RMDs begin. Large account equals large RMDs. Large RMDs equals large taxable income. And large taxable income in your 70s means potentially being pushed into higher tax brackets at an age when you have far less flexibility to adjust. The retirement date you chose at 63 or 65 created a chain. The chain leads to account balances at 70. The account balances at 70 create RMDs at 73. The RMDs at 73 create taxable income that determines your tax bracket, your Social Security taxation, and your Medicare premiums for the rest of your life. This is why the retirement date conversation is not just about the year you retire. It's about the entire trajectory that follows. And the people who understand this, who see the full chain before they make the first decision, they retire with a profoundly different financial outcome than the people who picked a date based on sentiment or convenience and discovered the consequences years later. Now I want to shift gears slightly and talk about Social Security, because the retirement year effect on Social Security is one of the most underappreciated parts of this entire picture. Most people know that up to 85% of Social Security benefits can be taxable depending on your income. What people often don't fully grasp is how the retirement year income spike affects that calculation. Your Social Security taxation is based on what's called your provisional income, your adjusted gross income, plus non-taxable interest, plus 50% of your Social Security benefit. In a year where your salary is still partially running, your provisional income is artificially elevated. If you also start Social Security in your retirement year, which many people do, the combination can push you well past the threshold where the maximum percentage of your benefit becomes taxable. And here's the compounding problem. Once people start Social Security, most of them don't stop. The benefit is ongoing. But the year you started it, you may have paid taxes on it at a rate driven entirely by temporary retirement year income stacking, a rate you'll never see again because the salary is gone. So the decision to start Social Security in your retirement year, in a year when your provisional income is elevated, can also set a psychological and practical precedent that people don't always think carefully enough about before they take that first check. The smarter path, for those who have the flexibility, is often to delay Social Security past the retirement year entirely. Let the salary disappear from the tax picture. Let your income normalize in year 2 or 3 of retirement before you add another permanent income source to the stack. Use those early retirement years to do thoughtful Roth conversions at lower rates. And then, when Social Security starts, your overall income picture is balanced, your brackets are managed, and you're not paying maximum taxes on a benefit you earned through a lifetime of contributions. There's a behavioral element to all of this that I think deserves some honest attention, because the question of why people make these timing mistakes isn't just about information, it's about psychology. Retirement is emotional. It's one of the most emotionally loaded financial decisions a person makes. And when something is emotional, people often anchor on the wrong things. They anchor on a symbolic date, an anniversary, a birthday, a milestone, a season. They anchor on a feeling. I want one last summer, one last Christmas, one last spring before I leave. They anchor on social signals. My colleague is retiring in March, so I'll retire in March too. They anchor on inertia. This was my plan for 5 years and I'm sticking to it. None of these anchors are irrational. They're deeply human. The problem is that retirement timing has significant financial consequences that operate completely independently of how the date feels emotionally. The IRS doesn't care that October felt symbolic to Dennis. The Medicare system doesn't care that June felt right to Carol. The tax code doesn't adjust based on sentiment. It just captures the number on December 31st and works from there. And the gap between what feels right and what is financially optimal is where tens of thousands of dollars quietly disappear. This is something we think about a lot on Mr. Retirement, the distance between the emotional retirement and the strategic one. And the good news is that these don't have to be in conflict. With enough awareness and enough lead time, you can often find a date that honors both the emotional reality of what retirement means to you and the financial reality of how it should be structured. But you have to know both realities exist before you can balance them. Let me give you a practical framework for thinking about your retirement date. Something simple and actionable that doesn't require a financial planning degree to use. The first thing to do is run what I call a retirement income projection by month. Sit down, ideally with a financial planner or a detailed spreadsheet, and ask yourself, if I retire in January, what does my income look like for that full calendar year? If I retire in April, what changes? If I retire in October, what does the December 31st snapshot show? You're looking for the annual total in each scenario, not the monthly flow, because the annual total is what the IRS and Medicare care about. And often when people see the comparisons side by side, the right answer becomes obvious in a way that no amount of general advice could produce. The second thing to do is check your IRMAA exposure 2 years out. IRMAA is based on your income from 2 years ago, so your retirement year income affects your Medicare premiums when you're 2 years deeper into retirement. If your retirement year income is going to be high because of salary overlap, plan for that. Expect the surcharge. Budget for it. And where possible, make income decisions that minimize it, like delaying a Roth conversion to year 2 or keeping 401k withdrawals minimal in that transition year. The third thing, and this is critically important for anyone who hasn't started doing Roth conversions yet, is to identify your Roth conversion window. Once you're fully retired, before Social Security begins, before RMDs kick in, there is often a window of years where your income is at its absolute lowest. That is your Roth conversion opportunity. The size of that window and the tax rate you'll pay during it are directly shaped by when you retire and what your retirement year income looks like. If your retirement year is clean, low income, minimal salary overlap, your conversion window opens wider and starts sooner. If your retirement year is messy, high income, salary and pension and conversion all stacking, your window is compressed and your conversion rate is higher. Know your window. Use it deliberately. Fourth and finally, and I want to say this clearly, don't make your retirement date decision in isolation. The month you retire isn't just a calendar choice. It's a financial trigger that sets off a chain of consequences across your tax bracket, your Medicare premiums, your Social Security taxation, and your RMD trajectory for decades to come. It deserves the same careful analysis that you give to your investment allocation or your Social Security claiming strategy. It is not a detail. It is a foundation. I've been talking for a while now, and I want to bring this back to where we started, to Dennis and his October dream, to Carol and her June teaching career, to Frank and Helen and the $47,000 they kept. These weren't people who made catastrophic financial mistakes. They weren't reckless or uninformed in a broad sense. They were, in almost every way, careful and thoughtful about retirement. They just didn't know that the date had a financial fingerprint. They didn't know the snapshot existed, and now you do. What you do with that knowledge is up to you. But I hope that the next time you think about your retirement date, or the next time someone you love tells you they're thinking about retiring in October because the fall feels right, you pause for just a moment. You ask the question. You run the numbers. You look at what December 31st is going to show, and whether there's a smarter path that gets you to the same life with more of your money intact. Here's what I want to leave you with. Retirement is one of the most important financial transitions of your life. You've spent decades building the resources to make it possible. The strategy you use to enter retirement, including something as seemingly simple as the month you choose, can protect or erode everything you've worked to build. You deserve to make that choice with clear eyes and complete information, not with sentiment alone, not with convention, with knowledge, with intention, with a real understanding of what December 31st is going to look like and what it's going to mean for the years that follow. That's what smart retirement planning actually looks like. Not just saving more, not just picking the right stocks, but understanding the hidden mechanics, the timing effects, the snapshots, the lookbacks, the stacking, and using that understanding to protect the retirement you've earned. You've come too far and worked too hard to leave tens of thousands of dollars on the table over a calendar choice. And now, you don't have to.